But my name is Dr. Leon Perlman. I'm the head of New York at Columbia Business School, CIPI, and I want to welcome you to our interoperability in DFS webinar presented by Charles Niehaus. Charles is currently in Cape Town. So here's our agenda. We're going to talk a bit about the DFS overview briefly. The webinar is about 45 minutes, and then we're going to have a Q&A after the presentation. You can send questions to me, Leon, not to the presenter, please. And then there's a quiz straight after the webinar. It's a 10-question multiple choice quiz just after the Q&A ends. And the quiz link is in your email. And as you know, it's live for 2 hours only for certificate purposes. You can earn a certificate if you complete our 6 webinars and get 60% for them. So just about the observatory, we've been around since 2016, funded by the Gates Foundation, dfsobservatory.com. I encourage you to take a look through. There's a lot of interesting information, including our legal database. Some of our activities, we have that database I mentioned. We're busy working on model laws and regulations. We have summits, webinars, roundtable, one coming up on October 12th on de-risking, some publications, and we interact a lot with other organizations and standard setting bodies. So these are some of the webinars that are coming up. One on fraud and risk in digital financial services on September 20th, level 1 platform on September 27th. I encourage you to look at the events calendar on our website, and you can register there for the webinars. So as I said, you can also order, you can also obtain a certificate. You attend 6 webinars and get 60% for each post-webinar live quiz. And you must concentrate on the written content in the webinar today if you want to pass the quiz. So onto our webinar, Interoperability in Digital Financial Services, presented by Charles Niehaus, who's a good friend of the observatory. He's spoken at our conferences, and I've worked with Charles, and I can say he's Mr. Interoperability, if I can give him that title. He's a consultant primarily to CGAP and IFC in payments and mobile money, and been involved in the payments industry for over 20 years. He led the Tanzania domestic MFS interoperability project for IFC, and more recently contracted to FSDU to assist in enabling MFS interoperability in Uganda. So Charles has very deep understanding of not only the MFS and payments ecosystem, but specifically on interoperability. So over to Charles.
Thanks, Leon, and hi everyone, and thanks for taking the time to join. I think the more people in the space who have some sort of knowledge on how interoperability works, the better for all of us. So what I'm going to try and do in this session is kind of, I know various people have different levels of knowledge in this space. My aim really is to kind of just bring everyone up to the same level of speed, so that everyone's kind of an armchair expert and philosophically just is aligned to where the thinking is, or where our thinking is from a CGAP and IFC perspective on interoperability. The first thing I just wanted to clarify before we start is, sorry, these slides I'm going to talk through, we developed for the Toronto Center a while back. So I'm going to be talking through those. But DFS interoperability, or DFS, is a big word. And the context of today's discussion is that specific segment of DFS that I'm going to use the word is unstructured. If we think about banks in the emerging markets and you know, my frame of reference being closer to Africa, banks have reached about 20 to 30% of the populations. So there's already interoperability between the banks, you know, whether it's cards in the Visa, MasterCard, or the ATM kind of space, they're already there. There are various ACHs in place across many of these markets. So in that 20 or 30% of the population, we do have various forms of interoperability. What we don't have, or what we're starting to see in the unbanked space, in the mobile money space, structures that we're starting to put together. So today's context is not about interoperability between banks and traditional things like ACHs and cards and ATMs. It's about this whole unstructured space of mobile network operators and non-banks interacting with banks and between each other in the traditionally unbanked space that we're now starting to put structures around. So what we're going to try and do today is elaborate on the concept of DFS interoperability, because as you may have heard, in many markets, people are talking about it, but in truth, very few are actually doing it, and arguably even fewer may be doing it on the right path. But before we explain the topics we'll be covering in this section, we're going to demystify interoperability. So why do it? What is it? What are the different definitions for the stakeholders? And what are the different stages? Then we're going to try and clarify the confusion that's often created between the concept of a switch and the concept of a scheme, and how governance structures in these should work and what's best practice. But just as a starting point, you know, many people kind of, a few years ago, we would say, is interoperability a good idea? Now that, you know, we've been on that journey for a while now, and that horse is almost bolted. So we've already got, from the G20 high-level principles, Principle 4 talks about digital financial services infrastructure and ecosystems, and it talks to interoperability. And there are actually some action items on it. And similarly, with the Better Than Cash Alliance, the RDP guidelines also has Guideline 5, which talks to interoperability. So there's already, you know, the momentum's built that interoperability needs to be sorted out. The question is how and how should it be done, and which is the work we're starting to do in many of these markets now. So after demystifying a bit, we're going to explain the rationale of the different commercial incentives and what drives commercial entities to want to do this. There's a belief in many camps that if there's no commercial incentives, then interoperability won't work. And here we'll go through one example of one use case or a transaction type to give you some insights into the commercial thinking which the commercial entities go through. We have to remember that there are businesses in all of this, and businesses are there, you know, to drive value for their customers and ultimately drive economic benefit. So we need to understand how they think about this as well. Then we're going to look at models of making interoperability happen. You know, often you find someone just comes along and says, let's just put a switch in the middle of all of this. But that's not always the case of how to solve it. There are many ways of looking at it, and just a piece of technical kit isn't always the only solution. There's a lot more to it than just dropping a switch in the middle. Then we're going to look at the current status of MFS interoperability. And I'm using the word MFS just because it's probably better than using banking interoperability. But as I said, the context is the unbanked space and all these non-bank operators that are interacting with each other and with banks. And then finally, we're going to look at the pros and cons of mandating it or not, and the roles of the regulator and where they kind of fit into all of this. But as a start, let's just go through, before going into the detail of payment interoperability and what it is, we need to look at the theory that exists behind it and what the incentives are. As a challenge in the payment space is that we can't actually track down any data on any industry, in the industry to measure the effect of interoperability from before an industry was interoperable. So in other words, when they were proprietary, to when the different entities opened up and started transacting with each other. Now, hindsight's the best yardstick, but you know, we can't track down any data, and the best people that would have been able to do this is Visa and MasterCard, I guess. But you can't actually find data of when a bank was pre-Visa and MasterCard and what their ATM revenues looked like, and then once they joined a scheme and how those transactions opened up. So the proof point in the payment space is, in the traditional space, all banks do it, well, most banks do it, and most banks join interoperability. But to actually have a data point to say you had 5 transactions when you were proprietary and now you've got 20 when you're interoperable, we don't have that data. So it's tricky to actually justify as such, but we know it's implicit in there. So the closest parallel we can actually find is in the mobile telecommunications business, where there's a guy called Metcalf. I actually don't know how many years ago he came up with a rule. But the theory was the value of a network is proportional to the square of a number of connected users in the system. So in more simple terms, the more people who are connected and transact or talk to each other, the more valuable the broader system is to everyone. And this doesn't only apply to the mobile telecommunications business. There are many parallel industries that are interoperable. I mean, we've mentioned already, things we do every day. If it's in the card space, you use your Visa, MasterCard, Amex or Diners in any country, anywhere in the world you go where there's acceptance. Similarly, if you think about how you book an airline in the days before Amadeus and Galileo, you'd have to book with a specific airline. Now you can go to any travel agent and they can pretty much book for you. And similarly, phone calls, you just dial a number. You don't these days have to worry about, is there a bilateral agreement between your mobile network operator and another network operator. You can just dial, and most providers are connected these days. Mobile financial services, however, or the bottom end of the pyramid, or in the unbanked space, isn't there yet. We're now starting to see a world where these businesses are now growing and they're starting to reach kind of the edge of their walled gardens, and the ability to be able to send money from wallet to wallet is now starting to take shape and starting to form. But there's no ubiquity in this yet, and this is the work that the global industry needs to do over the next few years, is that we start structuring this world properly so that we don't land up in a world of bilateral agreements and bilateral connectivity and all these kind of things. And we've got to figure out what the structure should look like. Now, before we go into that, when you get on Dr. Google and you ask the word interoperability, what it kicks out is pretty much technical jargon. Oxford English Dictionary is basically for computer systems to talk to each other. Similarly, on Wikipedia, it's systems interfaces and all of that. So we struggle in the payment space for a definition on interoperability. The best is probably the European Central Bank that talks about procedures to clear and settle transactions, which once again is on the technical side, I'd say, but it's closer to what we need to understand from a payments perspective, which is essentially once a transaction has taken place between end users, how will institutional settlement take place, and what do the settlement guarantees and processes look like? The challenge is that none of these definitions talk about the business behind interoperability, which is an absolutely important component that drives behavior, and behavior across the whole value chain, from end users, whether it's senders and receivers, to switches, to providers, and all the institutions involved. And as I mentioned earlier, we need to bear in mind that these institutions, they spend vast amounts of money growing their customer bases and distribution footprint. And there will always be resistance against competitors getting a free ride. So understanding the economics of these businesses is also important on top of the technology. So the question is, will we ever potentially really see effective interoperability unless there's a clear economic incentive for all these businesses to open up? And once we crack that, then we're on the path to actually have decent volume in this space. So, when we come closer to DFS and the scope and terminology and the world we're talking about, many of you may define e-money to e-money interoperability, and CGAP has proposed a very helpful framework of looking at it. And they look at it at 3 levels. One is platform level interoperability. And platform interoperability is probably the neatest and simplest. And this is where you can send money directly from one platform to another, or one service provider to another. And more practically, where you can send from, let's say, your M-Pesa wallet to your Tigo or Airtel wallet. So it's provider to provider, from my platform to your platform. So that would be deemed platform level interoperability. The next type of interoperability CGAP talks to is agent level interoperability. And this one gets a little bit more complicated. Not necessarily from a technical perspective, as technology can enable most things these days, but more from a business perspective. If you recall earlier, I mentioned that operators spend millions on creating distribution networks and want to avoid competitors getting a free ride. So the challenge with agent level interoperability is firstly figuring out the business model and the economic incentive for getting involved in agent or enabling it. What we often forget with the agent in the mobile money space is the agent is also the GSM airtime sales guy. So he's selling airtime for a provider, and now all of a sudden when we talk about agent interoperability, we're expecting potentially an agent who sells airtime to close his sales channels of another provider to start just doing mobile money transactions through that. And it's almost like saying a bank needs to service another bank's customer in their bank branches. So there's an argument to say bank branches actually aren't interoperable. You can't walk into a Citibank and service your Barclays account. You can send money to your Barclays account, but you can't service your Barclays account. So similarly, we've got to unwrap this whole challenge of the primary business being GSM and this mobile financial services business that's overlaid on top of it. And what we must be sure that we don't confuse is agent interoperability with agent exclusivity, because they're very different terms. If you think about agent exclusivity, in many of the markets, mobile network operators would go to like let's say a spaza shop and say you would only sell my airtime and you would only service my mobile money customers. That would be agent exclusivity. The other one is if they're not exclusive, then that agent would have, like, let's say, service 5 different providers. Agent interoperability means he'd have a primary relationship with one provider and be able to service the other guys, and that's the one that hasn't quite been unpacked yet. And then the last one is customer level interoperability, and this is probably the most complicated. And this is mainly due to the dynamic of the GSM business. And this is a scenario where you, for argument's sake, have an Airtel Money wallet on, let's say, a Vodacom SIM. And how would all of that work? So to keep things simple, we have to start somewhere. And that easy place is non-platform interoperability. So if we get down to the basics, we have to bear in mind that this industry is still quite new. M-Pesa in Kenya, you know, is the kind of the poster child, or that a lot of people look at. If you think about them, they actually just probably got traction now 10 years ago. It was 2007 when those Kenyan elections happened, which was really a key milestone for M-Pesa to get traction. So it's still a new industry. I mean, banks were around for 300 or 400 years before Visa and MasterCard came along. So we sometimes are a bit impatient these days, and we have to work with the pace of the industry as well. But in its simplest form, interoperability means moving money from a sender to a receiver who hold accounts at different institutions. Like, that's kind of how we're looking at it at the moment. But also, it's not always as simple as that, because each transaction type or payment stream or payment instrument has different attributes. So, for example, the channel it's accessed through, the access mechanism, the authentication protocols, business models, and more. And to clarify this, it's easy to present a card at a point of sale. You swipe it or you dip it. But all of a sudden, you can't just these days present a mobile phone at a point of sale. You can't swipe it or dip it. Now you're starting to see QR codes and those kind of things developing. But these have got different interfaces. So when we start talking about interoperability, you've got to unpack it and you've got to say, well, what are we actually talking about? You know, are we talking about sending money from me to you through what channel? How's it going to be authenticated? Who's going to be debited? Who's going to be credited? How's the business model and all those things going to work? So the important thing to remember is that when you look at interoperability, it has to be defined and agreed in much more detail than simply saying everyone transacts with everyone else over a switch. I mean, often you walk into a market and someone would say, we want an interoperable market. We're going to have this aggregator and just connect everyone to everyone, and that's going to solve all our problems. And then when you start unpacking it here, but what are you actually talking about? Are you talking about P2P transactions? Are you talking about a cash in? Are you talking about an ATM transaction? What are you actually talking about? So the important thing is to start thinking, where do we start in these markets with which transaction type and which specific use case, rather than just saying, we're just going to solve everything for everyone all at the same time. Now, the biggest thing that often has to be unpacked is this whole concept of a scheme and a switch, because the boundaries need to be understood. As I mentioned earlier, very often there's a thought process that a switch just solves interoperability, and you can have a look at many markets that have got RFPs out for switches. There are a lot of RFPs out for switches, but not that I've actually done the research, but I'm willing to bet not one central bank anywhere today has got an RFP out for a scheme, because there's often a thought process that says a switch solves everything. But to articulate the relationship, you know, often we think a switch solves for interoperability, but we have to think about it that a switch actually enables interoperability, and more broadly, a payment scheme defines all the attributes of how the interoperable transaction should work. So if you look at what does a scheme do, a scheme would define the technical standards to participants of the scheme. So let's use the one we all know, the card schemes. Technically, they use something called ISO 8583 or more recently 20022. So the scheme would say anyone who interacts between each other must use ISO 8583. And then the switch enables on that technical standard to say, we'll use ISO 8583. And in there, the schemes would write a bunch of business rules that says, you know, I don't know, reason code 52 means this and all sorts of things like that. The next thing the schemes do is they define the revenue splits, who pays for what. So as a business, we agree, I'm going to pay for this, you're going to pay me, and all sorts of things like that. What the switch does is the switch does the maths between working out who pays who when it comes to net settlement or however the transaction works. The scheme would define the business rules. And there are many business rules to interoperable transactions. You know, you could have transaction limits and all sorts of things like that. And once again, the switch would manage that those business rules are met and implemented. The switch also defines rules, the scheme also defines rules and standards around risk and fraud. So, you know, easy one in the card space, if you think about EMV, in many markets, EMV has rolled out, but you couldn't switch the world over all at the same time. So something called a liability shift came along to say, okay, as a business, we agree that if your point of sale is still mag, Stripe, and an EMV card is presented there, and there's fraud, then the acquiring side of the business would take a fraud hit. The switch would manage all the different transaction types and understand that that was a mag, Stripe terminal, therefore the liability would shift that way. If you think about disputes, as businesses need to agree a dispute and a customer protection process. So let's use an easy one in the mobile money space. I send money to the wrong phone number and boom, it's gone. How do we agree that I'm going to get that money back as a business? The switch doesn't agree that. The switch facilitates that I can get it back. But the switch doesn't put an agreement in place. Businesses and real people have to sit around and agree these kind of things. Then you start talking about common brands and acceptance marks. If you look at businesses, once again, you know, like Visa and MasterCard, what many people don't realize is in many domestic markets, Visa and MasterCard transactions don't actually switch through Visa and MasterCard switches. They switch through domestic switches in many of these markets. So switch is independent to the scheme. And schemes can be domestic or international, and so can many switches. So it's the important bit is just to ensure that when markets start looking at interoperability and someone uses the word switch, the question has to be asked, well, what are the scheme rules going to look like? Rather than saying, okay, let's just put in a switch and that's gonna solve interoperability for us. So when you start looking at kind of levels of interoperability, similarly, CGAP came out with a few different levels of interoperability. And for the sake of time, I'm going to just try and skim through them quite quickly. You know, the first one being theoretical interoperability. Now, often this is, you'll see central bank regulation coming out to say systems must be able to be interoperable. So theoretically, whatever system you implement, you must theoretically be able to link up. And these days, you know, with technology, most things are theoretically interoperable. So that's not really a biggie anymore. And then when we start talking about technical interoperability with standardized interfaces, so these are when you start putting in standardized interfaces that can facilitate exchanges. Functional interoperability, that's kind of where when you get a more robust example of level 2 where you have SLAs around uptime and those kind of things in place, but it's still missing inter-party business agreements, which shouldn't be confused with switch fees, because switch fee is just a technical fee. The inter-party business agreements I'll talk through a little bit later. Then when we start getting a bit more serious about interoperability, we get to level 4 and 5. And level 4 we deem as interconnected. So that's technical interoperability. And probably the best example, although some of these things are drifting a bit these days, is ATMs, where ATMs are technically interoperable. You can transact, there are business rules, there are dispute rules in place, risk rules, and all of those things happen, and you can transact at an ATM, but there's still something that holds it back from being at the highest level, which we call effective interoperability, and that's the pricing. ATMs have what we call surcharging in many markets, where you would transact at your own bank's ATM, and let's say you pay nothing at your own bank's ATM, But then when you go to another bank's ATM, you would pay what we call an off-net fee or a surcharging fee. So your personal economic behavior then says, hang on, I'm rather going to go and hunt for my own bank's ATM rather than do a real interoperable transaction. And for my ATM transaction, if I go to another bank's ATM, it's actually a grudge purchase because I have to pay more. Then when we talk about effective interoperability, that's really to say, okay, you don't really care how you transact and with who. And the best example is where the scheme's got this, I think, absolutely right, is in the point-of-sale space, where you don't take your card and go to a merchant and say, have you got a Barclays terminal or a Citibank terminal? You just swipe your card because you don't pay more for an off-net transaction than you do for an on-net transaction. So the key is that you start thinking about when these markets get structured, do we just want a switch that just sticks things together, or do we actually want people to transact and put volume through the switch? And the key part in all of this is all the different pricing decisions that markets make, whether they consciously think of it or not, is going to, at the end of the day, drive people to use these transactions or not. And I'll try and wrap that up and explain it towards the end of the session. So the question we have is, if we agree the switch is a technical thing, then there are a couple of things which have to be agreed from a scheme perspective. And the question is, well, what do businesses have to agree? Because the only real thing you kind of see is you get a vendor in and you drop a switch. But there's a lot more to it. And well, when I say a lot more to it, there's basically about 11 things that businesses have to agree when they want to be interoperable. And the primary thing is, they've got to start at a specific transaction type. They've got to say, okay, we want to do P2P interoperability, or we want to do cash-in interoperability, or ATM interoperability. So you've got to pick a specific transaction type. And then you've got to say, okay, who are the members? What's our membership criteria and who participates? You know, if it's mobile money wallet to a mobile money wallet, or mobile money wallet to a bank account, you could say the participants here are banks and mobile network operators, and they should sit around the table and agree all these things that I'm going to come with now. The question you've got to ask yourself, do you have someone at the table that doesn't have a vested interest, or would they just bring noise to the table? So generally what you find in the banking space is when it comes to ACH agreements, that would be banks sitting around the table, because it often doesn't make sense, I don't know, for someone else to sit around the table because they don't really have skin in the game. Then the next thing is they've got to decide how their transaction formatting and transaction handling work. So let's all agree a technical standard. And Leon, I don't know if you've had any of the ISO guys on any of these calls, but there are mobile money standards coming out in the ISO space as well. And similarly, what would be 2000 or 8583 or something, you know. So, but agree the transaction handling and the formatting. Then businesses have to agree dispute resolution process. You know, internally, if I send money to the wrong telephone number, I've got some internal process that I take care of it, but I own the journal, so I can do the debits and the credits, and it's pretty easy. As soon as you send money off net, all of a sudden the money's gone to the other side. Now, what sort of legal agreement, or call it a prenup, do we have in place if you're going to get my money back? It can't just be because we're friends or we played golf on Friday or something. There's got to be something written down. Similarly, intermediary compensation. What does a business model look like? Another word for this is interchange, and in the mobile network space, interconnect. These businesses are never really balanced. So you've got to start thinking about how do you balance the economics of these things. And then there are a couple of other things like risk and cost sharing and those kind of things. So businesses have to agree all of these things. Next thing that's often asked is regulators say, well, you know, we're going to tell people to do it. But what you struggle with often in the emerging markets is where this all fits in the regulatory hierarchy. So what cookie cutter markets almost should have is a banking act, and the banking act often gives the central bank the mandate to run with, or the National Payments Act to run with directors and position papers. And then the missing thing in many emerging markets is payments associations and those kind of rules. But the business rule sits at the level we call ACH agreement or participant group rules. And those don't necessarily have to be done by central banks. They just have to be compliant with what all the acts say. But often industry doesn't organize themselves because they don't necessarily know how to structure themselves in the absence of these formal structures. So you then find central banks start getting involved in business agreements. And central banks should try and give the businesses leeway to keep going. So for the sake of time, I'm going to just just show you that there are already heaps of examples of ACH agreements. So it's not, what I'm talking through isn't rocket science. It's been done for years and years and years. It just hasn't necessarily been done in the mobile money space or the unbanked space, except for examples now which we're seeing in Tanzania and Uganda and a few other markets that are starting to develop. So the other area I want to cover, just to make sure everyone understands this, is kind of the business of interoperability, because people often just go, as I mentioned, you drop a switch in and the switch fee is X. But we have to understand that in a two-sided market, the economics aren't always balanced. And I'm just going to pick the example of a P2P interoperable use case. So I cash money in, the agent gives me e-money, so I give him physical cash, he gives me e-money. I then send from myself to my mother, and she goes and cashes out on the other side. At the moment, in the proprietary space, what we're finding is the business model in this one is weighted towards the cash outside of the business. So I don't know how many people on the call are familiar with, I'm going to call it the East Africa business model, but when you cash in, the agent receives commission and the provider pays a commission. So that's the column on the left-hand side, number one. When you send money, you pay a little bit, and the provider earns money, but that money doesn't wash its face of the cost it's paid the commission, so that's a low amount. And then on the cash outside of the business, essentially the subscriber pays a big amount, which the provider then earns. The provider pays the cash out agent a commission, and that cash outside of the business really carries a lot of the business. So it then makes sure at a net the provider is whole and he makes money in this whole transaction. But if you think of a line now between the send and the cash out, if you become interoperable, all of a sudden the business is weighted on the cash outside of the business, and you'll just want people being cash out agents because that's where the money is, but no one wants to be a cash in agent. So if we go back to all the different business models, and this is just something that came up in Tanzania, is they decided on a few principles to say, okay, we want to go for the concept of effective interoperability, which means we don't want to get people to pay off-net transactions. So we want people to pay exactly the same for an on-net or an off-net transaction. So in that scenario, if you come with a sender pays model, which means the sending institution reimburses the receiving institution amount of money, which is that thing at the bottom called mobile P2P interchange, all of a sudden the sending institution is going to run at a complete loss, and the only way they could do it is by surcharging their customers. And this often happens in the cross-border space that you'll see these days. So consumers then surcharge and they stop transacting and there's no interoperability. But technically it may happen, but actually as a business, no one has an incentive to transact. The second option is to say, the easy one, to say, okay, let's just have no interchange. It's much easier and let's just do it like that. But similarly, if you have no interchange, the sending side of the business is out of pocket. And the receiving side of the business just receives free money and they say, thank you very much, we'll make a lot of money. And the incentives aren't balanced. So kind of the morally right way to go is for the receiving side to say to the sending side, okay, we recognize you've paid a cash-in commission. We also recognize we're getting the cash outside of the business, so we'll reimburse you an amount. And whatever that amount is a business agreement to be fair on both sides. And to give you an idea on volume in Tanzania today, after about a year and a half of the full market being in, it's about $100 million a month, and it's about it's hitting about 30% of all P2P transactions in Tanzania today are interoperable. And, it's a function of a whole lot of things, and I believe the business model is one of them. So the important thing to consider is the inter-party business models, and this is very different to the switch fee, and it's also better in many markets to go the difficult route and figure it out than rather just go the easy route and say, well, it's fine. We just won't have an interchange model, because if you don't have business models that are understood and fair, then all of a sudden you start surcharging the end-to-end transaction, and for poor people, they actually end up paying more for the transaction, which isn't what we're trying to achieve. So now if we understand that we need scheme rules, and in those scheme rules we agree a whole lot of things, and one of them is business model, the last question is, well, how do we make this happen? And the question there is, often is, let's just put a switch in. But often you actually have to understand that switches also cost money. I mean, to stick in a domestic switch these days is somewhere between $5 and $10 million. So the switch also has to wash its face, unless, there's a lot of development money around these days. But as a business, a switch has to make sure it actually is sustainable, because what happens is if switches are too expensive, those switch costs start getting passed on to the businesses, and the businesses pass it on to end users. So markets need to look very carefully at who's going to pay for all this stuff before implementing it, that there's actually a sustainable business model in it. So switches, arguably are better than bilateral agreements, and bilateral agreements are clumsy and messy, but they are also a means to an end. So markets have to have a clear strategy to go, how do we do it? The amazing thing about Tanzania, where there's a lot of research going on it at the moment, but Tanzania actually has started with interoperability without a switch. So those volumes I spoke through earlier aren't necessarily because of a switch, because there is no switch. They've done the kind of the glorified correspondent banking Vostra Nostra concept. Having said that, it's not the best because smaller players are locked out. But I believe the smaller players are also locked out not necessarily because of the switch, but also because of the business agreements that aren't at this stage yet at a multilateral level. So there's a lot of things to figure out, but markets can think of bilaterals or switches. But the message in here is don't default to a switch initially. If you think about Africa, we've got 52 odd countries, depending on where the border posts are drawn these days. But if you imagine Africa with 52 switches, the only people who are going to make money out of these switches are going to be software vendors, and all those costs are going to be passed on to end users. So we've got to think very carefully about the interbank strategies and interparty strategies across Africa as we go forward. Because we've already, we've just done an exercise in CGAP now. In East Africa alone, in each East African country, you've got roughly 7 or 8 different entities facilitating interbank transactions, whether it's an ATM switch or an ACH or some sort of aggregator, and that's only for 20% of the population. So we have all these people sitting at the center, and all those costs are being passed on to end users. So we've got to start thinking about many of these markets more regionally. And I pick Africa because it's, it's got 52 places. Obviously India and China and those markets are easier because you don't have to worry about all the aggregation and stuff. But we've got to be careful how we start thinking about, our switching strategy. So I think I'm starting to run out of time. Just, Leon, I don't know if these slides are going to be made public, but we've got to start thinking about the risks with interoperability. But once again, the risks aren't rocket science. They've been around forever. The banks have been figuring this stuff out for years. So there are a lot of lessons to learn, whether it's credit risk, settlement risk. Banks have figured out how settlement agreements work. Liquidity risk, these are things that the MNOs are learning at the moment. Is if your pre-funding account isn't funded, then how do you make sure transactions still take place? There's obviously operational risk, legal risk, and reputational risk. The key thing with all of these risks is we have to ensure people trust the system. So reputational risk is probably one of the most critical ones. All of these other ones you can put controls in place. So risk is obviously an important thing to look at. If we look at how interoperability is playing out at the moment, there's a lot of domestic schemes starting to take place, but the plays are very different. Very few markets are starting with a sense of putting industry together and saying, let's decide scheme rules. Many of them are regulatory-led or switch-led. And it's important for central banks to start thinking and having a clear strategy. So for the market level people on this call, just all I can urge you is when you in your markets and you start looking at interoperability, you got to decide as a country, what is it we want to try and do? Like, have we got all the building blocks for interoperability in place, and therefore what experiences are there? We've got examples of regulatory mandates. Where often a regulator would mandate. Nigeria was an example a few years ago where no one could get a mobile money license if they weren't connected to NIBs. And they hadn't thought through the scheme rules and the inter-party business rules. So everyone was connected, but there were no real transactions flowing. So technically, yes, we're connected and we're interoperable, but no one's really using the service. So you've got to think about whether mandates are a good idea or not and what those are trying to achieve. Secondly, also technology-led solutions. Now, there are a couple of different ways of looking at it. One is like, dropping a switch in the middle that connects the users. Now, that's a good idea as long as it's understood exactly how much it's going to cost and whether it makes business sense, and if all the scheme rules and all those kind of things are in place. Understanding that a switch needs volume to be justified. And that volume comes from a function of the business rules and the business models. Then often, you look at markets like Peru and Jordan, which is everyone's on the same kind of technical platform, although those are more mobile banking kind of models. So it's not necessarily platform to platform because everyone's on the same platform. So you've got to look at the technology-led models and see what are the pros and cons in those. And then lastly is whether you do an industry-led approach. Now, industry is obviously a lot tougher because as a regulator, you kind of don't say to an industry, do this and do it this way. You've got to get industry to lead and figure it out. But that may be a better long-term buy-in because then you actually have providers buying into it for the sake of their businesses and what makes sense for them and their customers rather than a compliance function. What we have to avoid if we want to see long-term interoperability and people actually using these services is that interoperability isn't a compliance function, but rather a business function. Because if it's a business function, it'll be good for everyone. If it's a compliance function, yes, absolutely people will do it or institutions will implement it, but no one will really use it. So I'm going to end there. I think my time's up. So Leon, I'm going to hand over the controls to you. I just need to find you on the drop down. Oh, you've got it. Okay, thanks.
Everybody hear me?
Faintly.
Hello?
Yep.
Oh, great. Okay. Charles, could you advance the slides for me? Don't see.
Oh, no, I think I've done that. I don't have. I think you've got that. Yeah.
There we go. Okay. Great. So that was pretty comprehensive, and there are already questions coming in. I mean, this is the future of DFS mobile money, and pretty important. And you've shown some good success stories there. So getting it right is important. So, question from Samvit. Whoops, it went away. We're going to have some polls, but question. Let's do the poll first. Okay. So if you could just quickly indicate what your organization type is, please. And while you do that, it's going to be for a few more seconds, just to let you know that the quiz link is coming to you. Should be in your email. Check your spam folder. You have 2 hours from the end of this webinar to complete 10 multiple choice questions, and if you've listened attentively to and watched attentively the slides from Charles, you should get through it pretty well. Okay, so we're going to do 2 polls, and we're just waiting for some questions to come through as well. Okay, let's see, next poll coming up. So just also let you know about the webinars that are coming up. The next one is on risk and fraud in mobile money. That's presented by Mercy Baku. That's on the 20th, and then on the 27th, Costa Peric of the Bill and Melinda Gates Foundation will give introduction to the Level 1 platform, which is kind of ancillary to what Charles is talking about, because it's an interoperable platform that a standard of sorts which the foundation has put together. Okay, so I think if the poll isn't coming up, there's another poll. Okay, which region are you from? So while you're doing that, just again, Costa Peric will talk about Level 1. They'll be on September 27th, and then we've got others coming up on competition and de-risking, And also we're hosting a roundtable in New York, if you're here, on de-risking. It's a very interesting topic that's affecting financial inclusion because of the issue of entities not being able to receive funds from abroad and disperse to those at the bottom of the pyramid. Okay. So let's get to the questions. From Sumvit, thank you for your patience, Sumvit. How is platform-level interoperability different from customer-level interoperability if we remove the difference in usage channel GSM in case of customer level? That's clear for you, Charles?
Yeah, I'll have a go at that. So platform-level interoperability, in, I guess in its purest sense, would be I'm an Airtel GSM user, and I've got a Airtel wallet, and I send from my, let's say Airtel's on Conviva for argument's sake, I send from Airtel to a Tigo GSM SIM card holder who's got a Tigo wallet on his Telepin platform. So that would be Airtel GSM Airtel wallet to Tigo GSM Tigo wallet. So that would be platform level interoperability. When we start talking about other levels of interoperability, so customer interoperability would be, I could be, technically there's nothing that stops me, although maybe technical rules and those kind of things, where I could be an Airtel GSM subscriber with a Tigo wallet, and that starts getting very confusing. The easy part in all of that is if we strip out the dependence or the ancillary business of mobile money being a, let's say, a value-added services to the GSM business, you're starting to see a lot of independent wallets coming into play. So it would almost be easier for them. But that would be the primary difference, is kind of platform level interoperability is easier to understand almost, and it doesn't get confusing.
Right, that's very clear. Thanks, Charles.
Yeah.
From Ahmed in Cairo, could you explain what type of mandates for interoperability are possible and what the advantages and disadvantages they are? I assume those are from the regulators.
Yeah. So, I'm come from a commercial background. I've never personally been a fan of central bank mandates. So my answer to that would be, when it comes to businesses, businesses have to make sense. And I've just often seen mandates being put in place in markets with the right intent, but often with the wrong outcomes. As a start, regulators often get involved in pricing mandates. So they would say, okay, we need to help poor people, we make transactions free. And then all of a sudden, let's just pick an example, like they make ATM transactions free. Not realizing that a bank actually has to pay $40,000 or $50,000 for that ATM, and it's got to manage a cash in that ATM, it's got to stock that ATM. So the bank then starts running at a loss, and then they start reducing their ATM footprint, and then the regulator goes, what's the next thing I'm going to do? No, I'm going to mandate that a bank must have a certain amount of ATMs, and they start shutting this thing down. Like a great example is in Nigeria years ago, the central bank mandated in the card space, basically merchant commission was capped at about, I think it was 1.75%, I can't remember the exact amount now. And no issuing or acquiring bank was making money out of the card business, yet they were issuing millions and millions of cards. And I could never figure this out until I sat with a banker one day and I said, you're still issuing cards, but you're not making any money out of it. Why not? And the guy's answer to me was, no, we're making lots of money out of it. We just put a $2 or $3 card. We put a 2-year expiry date on the card, and we charge a $5 card renewal fee. So the bank was basically selling plastic, and there were no transactions going through it. So the question is, what sort of mandates do central banks want to achieve, and what are they going to achieve? So I guess I'm not giving you a straight answer, except I would say central banks should encourage industry and put structures in place so that industry can sort things out and get to the right agreement, and strongly encourage industry in the right conditions to do things. But it shouldn't start getting involved in pricing and those kind of things. And that's my personal view, so it's not a CGAP view of anything.
Would that mean that, as a broad policy, that interoperability is desired by the central bank rather than mandated?
Yeah, I mean, if you look at like a classic one of interoperability in most markets, what people don't realize, even in the card space, is I'm not aware of card interoperability. I mean, there are a couple of markets, but that it's ever mandated. If you think about it, banks join Visa and MasterCard and domestic switches because it makes sense for their business. And what you always find is the big bank usually moves last, but they move at some stage. Whether it takes 10 or 15 years, they get there when it makes sense for their business. But when you force people to become interoperable, they start treating it like a compliance function. And when it becomes a compliance function, it gets given to the compliance department and not the business department. So the central bank would tick a box to say, my market's interoperable. But I would almost say the next box to tick is, but are people actually transacting? So they should encourage it, and they should encourage market structures. Should they mandate it? I guess I'm yet to see examples of where mandates have achieved the proper outcomes for customers, and where people actually transact, and it makes sense for everyone in the value chain.
Yeah, I think it's sort of obliquely referenced in a lot of policies where it says you shall endeavor to interoperate rather than chill. Yeah.
And obviously, if they are distorting market conditions, like a dominant player or something, then they've got to contemplate intervention and those kind of things. But I'm kind of talking from a purely balanced market perspective, where it makes sense and stuff. Yeah.
An ideal situation, not in most markets, I would think. Okay, from Veronica, can you explain a bit more, please, about the different technology-led initiatives versus industry-led initiatives, and how do you assess country needs when analyzing interoperability? What three issues would you look at? Thanks, Veronica.
Because I'm going to start with, when you look at the industry-led initiatives versus the technology-led initiatives, for me that's very simple. It's, are the businesses who have to be interoperable or want to be interoperable sitting around the table discussing how they want to do it? And does technology follow strategy? And those businesses, the people sitting there, are they the business people or are they the compliance people sitting at the table discussing it? To me, that would be an industry-led initiative. A technology-led initiative would be, there's an RFP out for a switch, and a central bank says, here's the switch, everyone link into it, and off you go. That would be, in my mind, a technology-led solution where the technology says to the business, here are your rules, this is how we can do it, this is how we can't do it. And it's not necessarily business decisions that dictate the technology implementation. When you start looking at markets to assess it, to me it would be the stage of market and the stage of market development. And to that is what is the customer need? Now in many markets we've started doing customer demand studies to actually understand, is there a customer demand for this or not? And in most markets, as you start doing it, markets lead a certain level of maturity and then customers start demanding it. Whereas in the early phases, they're just happy to transact in their closed networks. So to me, it's a market staging thing rather than off the ground get going. You've got to build the market first, and then when the providers start running out of volume and transactions and they want to start offering deeper customer propositions, then it's probably the right stage to start flicking the switch and become interoperable. I think that's where you see the success in interoperability. Where there have been examples, and a good example of that is probably Tanzania and Uganda now, where the markets have grown, they've got to some sort of saturation point, not the full saturation point, but they're getting there, and then all of a sudden the providers go, okay, hang on, now I need to start getting more transactional revenue, how do I do it? Interoperability adds to that. Versus markets that just start with interoperability from scratch, and then you go, have they actually had time to build their proprietary offerings, or they're kind of just destroying each other right from the start and they can't compete nicely. So the jury's actually out on that, and everyone's got different views. There's some people that believe you must be interoperable from the start. I'm from the school that goes, it's a market staging thing, and it's also a participant interest thing. As long as you have enough people that think it makes sense for their business to go, then they should go for it, and they shouldn't be held back because maybe a big guy doesn't want to do it or something.
Charles, could I suggest maybe also, this is my opinion, that under technology-led initiatives, not that there's a bright line between industry and technology-led initiatives, but I've seen a lot of the shrinking number of vendors, platform vendors, actually producing APIs that allow the interoperability. Maybe that self-serving and it just allows more people to participate in that vendors' offerings, but that seems to be an initiatives from a lot of platform vendors that are left.
Yeah, absolutely. But once again, that's technically enabled. So there's an API, and we can link in, and we can send money to each other. But what if I send you money to the wrong phone number, and we haven't agreed the stuff?
Agreed.
That's the stuff that has to be figured out. Yeah.
I'm just saying the vendors are feeding the possibility of.
Yeah, absolutely.
Yeah. Two quick questions. I think you can dispose of these in the 2 minutes we've got left. Easy one: are the business rules of various schemes available for entities seeking to implement these schemes? You and I have got a lot of experience on this one.
Yeah. Yeah. So, okay. And what's the second question?
What's the extent of interoperability between e-money and cryptocurrencies?
I'll go with the first question.
Okay, I don't think it's that easy to sense of it.
The answer is yes. So what we did is those 11 things that I spoke to, we're obviously in Tanzania and Uganda pretty much use the same ones. We broke those out into more detail, and it's about a 40 or 50 page document, and they're on an IFC landing page. So Leon, I don't know if you to this group make it available or whatever, but absolutely it's on it's public. And the only trick with that is what we have in there is about 5 different use cases and 5 different documents. So there's one for P2P, one for cash in, one for cash out. And obviously markets could use these as a template to start with. So there's absolutely no reason to start from scratch anymore like we did in Tanzania. To give you an example, in Tanzania we took about 4 months from starting from a blank page to having these rules written and agreed. In Uganda, we took the Tanzania rules and we said to the market, are these right or is these wrong? And we had 2 meetings and they'd sorted it out. So we've got arguably 85–90% of it written down. What we've just done now, and it just hasn't been made public yet, it's just more IFC internal processes, is we've taken those 5 different transaction types and just consolidated it into one rule set. So it's just more manageable, so you don't have 5 documents floating around. So it all just depends on what the markets want to do. I must add, though, the one use case we don't have on there, which we haven't cracked yet in this whole mobile money interoperability space, is merchant payments. Because at this stage still, you've got all the providers with different tech solutions and different business models and all sorts of things like that. So we don't have merchant payments sorted out yet, but we've got most of the other
Charles, just in the interest of time, we could just go on to the interoperability between e-money and distributed instruments such as cryptocurrencies.
Yeah, I'm not aware of any of that. We're still trying to solve interoperability between e-money issuers, so we haven't quite got to solving it with crypto guys yet.
Yeah, I think BitPesa is kind of case in point. They're doing work.
Yeah.
I suspect this is mostly through exchanges, through fiat currencies.
Yeah, so sorry, just to add to that, I'm talking at this from a multilateral perspective where businesses sit around and agree how they're going to operate at a market level. Obviously, there's a host of bilateral agreements between cryptocurrencies and whatever e-money issuers and banks and things. But from a multilateral perspective, I'm not aware of it anyway.
There is an initiative in the Caribbean, amongst the Caribbean central banks, to issue a digital fiat currency. It's not so much a cryptocurrency, but it's a fiat currency. So it dispenses with the need for e-money. Because the source of funds is immediately e-money.
Sure.
Okay. Thank you, Charles. That was great. And Charles, would you mind if folks emailed you questions as they are? I mean, we're running out. We've got lots of questions. Unfortunately, we couldn't get to all of them. We started about 2 minutes late, so we're almost on the cusp of an hour worth of webinar in total. And thanks to Charles in beautiful Cape Town for his time and effort. And Charles, as I said, is Mr. Interoperability, and he's happy to answer your questions. Just a quick one from the observatory before we sign off. As you know, we're working on 2 papers and projects, blockchain and financial inclusion and de-risking. And we'd like to get your input, those who online, or if you know somebody who can assist with some information, some examples of blockchain and financial inclusion use, and de-risking, examples of entities being de-risked and those doing the de-risking, such as mobile money operators. Send any info to info@dfsobservatory.com. So there's a typo there. So for those doing the quiz, it's live around now. Good luck for that. Again, Charles set the questions, so I looked at them. You should get through them pretty well if you've paid attention. And next time, until next time on September 20th, goodbye to you all. Please go register on our website for the upcoming webinars. So bye-bye from New York, and thanks for your participation.
Thanks, Ian. Cheers, Ian.
Thanks, Charles.